Hello, everyone, and welcome to our webinar discussing if Asian currencies will benefit from the US Sino trade tensions. This is Ming Hui from Phillip Futures, and speaking to you today will be Mr. Samuel Siew, our investment analyst from Phillip Futures. If you have any questions through the course of the webinar, please feel free to type them into the question box. We will have a Q&A session towards the end. And now, without further ado, let's hear from Samuel.
All right, so a very good evening to everybody. My name is Samuel. I'm an investment analyst at Phillip Futures. So for tonight's webinar, what we'll be actually covering will be, will Asian currencies benefit from the US Sino trade tensions? So I know that it has been key headlines recently whereby everybody is all talking about the Sino-US trade tensions. And without further ado, I will briefly explain what it is and move on to how it will affect currencies as a whole. So this seminar is solely for education purpose only and does not constitute to any form of financial or professional advice. A little bit about myself, I'm an investment analyst at Phillip Futures. I specialize in the equities, indices, and forex market. Day to day, I do provide daily commentaries on the indices and forex, and you may have heard me on radio, seen me on TV, or maybe seen some of my commentaries on the newspaper before. So in a nutshell, what the Sino-US trade war has escalated to is, if we look recently at the start of the month, US actually put additional tariffs on China once again. So what happens is that he have announced tariffs on additional 3 billion in Chinese imports. What it essentially covers is all of the US imports from China itself. And this have caused a huge worry on people because it's another form of escalation in the trade war. Even though President Trump have since actually exempted some of the products from it, we can see that this is one of the largest increase in tariffs so far. And right now, because even though he split it into two parts, one starting on 1st September and the rest on 15th December, if you add it together, it's about 270 billion. And this is much more than what has been implemented thus far itself. So with that, people are still very worried because markets have yet to fully digest the full impacts of the tariffs that have been implemented thus far. It has been quite drastic in the economic numbers. And so with that in mind, new tariffs coming in, people are very, very worried. All right. So we can see that in terms of the exports itself, some of the things were removed from it, but it will still strike very close to home because most of the tariffs are actually implemented on consumer products. So we can see that if you're looking at your cell phones, laptops, etc., your shoes, and all your sort of like consumer products, things that will affect Christmas season are all put into impacts. And that's why people are worried that the US economy or even the global economic slowdown is going to worsen further and maybe drag down currencies even more. But if we look at it, what happens is that President Trump has recently actually lowered the sort of like delayed some of the tariffs because he don't want it to affect the US Christmas season. But still, if it actually comes into place as a whole, we can see that the economic slowdown may worsen further. So with all this escalation in the near term, we feel that it's unlikely to be resolved anytime soon as well. We can see that there were two major criteria set for the truce in the first place. The truce was actually done at end of June during the Osaka G20 summit, but we can feel that right now both criteria have still been unfulfilled. Firstly, was the Huawei incident, whereby President Trump actually stated that he will actually let Huawei buy more of the US products, as well as maybe lift the ban on Huawei. And this was one of the major criteria that China set as well. They wanted Huawei to have fair competition in the US. But right now, if you look at the latest updates, even though there's a grace period of 90 days extension for Huawei, President Trump actually stated that he does not want the US to do business with Huawei. And all of these are actually going against what was the initial guidelines set for the truce to begin with. All right. Second is China's promise to actually purchase more US agricultural products. However, based on the current situation, it's quite impossible because there's additional tariffs being placed on China and things like that. And China is unlikely to resume large-scale purchase products under the current situation. All right. In fact, we note that China has actually suspended its US agricultural product purchases after President Trump have put in the new tariffs itself. So all of this are putting things on a very sour note. It's showing that at present it's unlikely the situation will be resolved, and this would cause more tensions and jittery in markets. There are also conflicting signals sent to market. President Trump have been saying that talks are ongoing, everything is good, but yet if you look at the other side of the coin, you can see that more tariffs are actually put on each other. They are trying to come up with measures to defend against each other. So all of these are very worrying signs, and there are huge hurdles left to be negotiated because what both sides want are very different from each other, and unless they can set aside their differences, it's unlikely that we will see anything positive in the near term. Although the US and China remains in talks, President Trump have also stated that he's not ready for a China trade deal. So this actually has put concerns on people's minds as well. So we can see the US-Sino trade wars, the impacts of the tariffs will be the ones weighing on investors' confidence, and it will transcend down to currencies as well. We can see that based on the current scenario, on the current tariff level, GDP levels are going to drop, and is by around, you look at global GDP levels, maybe around 0.2% this year. So going forth with all the tariffs put into consideration, the impact on global economy is going to be worsened as well. We can see it very obvious in the recent numbers that has been coming out from Asia, from Europe, etc. Yesterday, we can see that Japan's exports actually declined for 8 consecutive months. We can see that Singapore's exports has also declined for 5 consecutive months. Our GDP numbers have slowed down drastically. So all of these are showing signs that the trade war is affecting numbers as well. Germany, we look at their manufacturing numbers, it has been declining since the start of the year as well. It has been in contraction. So all of this will weigh on confidence, and people are noting that if more tariffs are to be placed and the existing ones not removed, the impact on global economy is going to worsen. So this has been forewarned by the World Trade Organization as well, and that the impact of a full-blown trade war will be worse than the Great Recession of the late 2000s. It has also possibly transcended into a technology cold war. We can see that with the ban on Huawei, etc., is actually impacting technology growth. You can see that because of the impact of the trade tensions in terms of the global economic slowdown, various central banks are also trying to ease monetary policies, and this has caused a fear that emerging currency war can actually start, because with a rapid slowdown or rapid easing of major global central banks, etc., it will cause currencies to devaluate, and if enough devaluation takes place, more fear will be struck in people. All right. There's also various companies warning that cost-related tariffs will actually hit their profit revenue and it will be transferred to consumers. And this was one of the reasons why the latest tariffs on a number of consumer goods were delayed. But if it's eventually put into place, we can see that there'll be a global earnings downgrade, and it's going to impact investors' confidence and the global economy even further. So we can see global economic slowdowns actually has been increasing the most since January, and with that in mind, people are looking at whether currencies are going to face equal slowdown as well. And we can see there has been flashing signs of recession ongoing. All right, what happens is that if there's a recession, if there's an economic slowdown, people are looking at safe haven currencies. People will be worried about emerging market currencies as well. And the last time, one of the key indicators we look at will be the yield curve inversion. So the last time the yield curve actually inverted was during the Lehman Brothers crisis back in 2006 and 7. You can see that the 2-year yield curve was actually higher than the 10-year yield curve. Okay, this is a huge implication because it means that putting your money in the banks for a longer period of time will get you lesser returns than putting the money in the banks for a shorter period of time. So it shows that consumer confidence are not there. People are predicting that the economy is going to worsen further. So we recently observed that there's a yield curve inversion once again. You can see that just last week, the 2-year yield curve actually edged above the 10-year yield curve. Even though right now it has reverted, but this is still a sign. Okay, it's interesting to note that since the start of the year, the 2-year yield curve have already crossed the 5-year yield curve. So with it inverting above the 10-year yield curve is really a call for concern. Okay, so it actually signifies recession, is a red flag for recession, and is actually very negative. Even though when you have a yield curve inversion, it does not mean that sort of like a recession will occur, but and there will be a market crash. But typically, if you look at the past, when a market downturn occurs or when a market crash occurs, the yield curve is always inverted. So with that in mind, people are looking closely to these signs and may look at safe haven currencies as a form of hedge as well. So for today's talking so much about the trade war is really just to give you an impact of how the trade war is going to affect consumer confidence and sort of like impact people's investments on currencies, just used as a gauge. So with so much negativity in the markets, people are actually looking at more safe haven currencies. People are looking at the less risky assets because in terms of economic downturn, we can see that the world's reserve currency or funding currency may actually gain more attention and gain more strength as well. So we'll be touching on this three Asian currencies per se. We'll be touching on the Japanese yen, the Chinese yuan, as well as the Singapore dollar. But needless to say, we have to touch a little bit about the US dollar as well, as the US dollar is used as a counter currency for most of these currency pairs. So how to understand Forex? Just a simple introduction is that we are always buying one currency and selling the opposite currency. So if, like example, you want to invest in the Sing dollar or Japanese yen, for example, it's always paired against the dollar and with that in mind, we have to monitor the dollar strength as well. Because if the dollar is strengthening, even if, like example, the Japanese yen is strengthening, you may not gain that much profit as well. And because the dollar is a commonly used counter currency, we have to see how the dollar strength is going as well. So for the US dollar, some of the fundamentals we have to note is that it is known as one of the safe haven currencies. It's also the world's reserve currency. So you can see a lot of Forex pairs based against the dollar. And after, it's one of the more commonly traded pairs as well. That means, for example, Japanese yen, US dollar, Sing dollar, US dollar, as well as maybe Thai baht, US dollar, or Chinese yuan, US dollar. So when markets are selling off assets, they want to keep their funds in safe haven currencies or the currencies that they borrowed so as to avoid losses in currency fluctuation. And you can see that in terms of an economic downturn, safe haven currencies will tend to benefit from there. Also, because it's often used as a counter currency in Forex pairs, its strength has to be closely monitored because if not, we may not, even if the other currencies are strengthening rapidly, if the US dollar strengthens equally fast, we may not see that much of an impact as well. So if you look at the US dollar's futures, we can note that the US dollar strength has actually weakened over the first half of the year. All right. And if we look at the US dollar JPY, we can see that it has weakened against the yen. Okay, some of the reasons why the US dollar weakened is because it's still deemed as a why the US dollar strengthened actually is because it was deemed as a safe shelter as compared to the other currencies. All right. That's why you can see overall maybe against other currencies like the euro, like the pound, or like the other emerging market currencies like the Australian dollar, New Zealand dollar, it's still deemed a much safer asset. And people actually focus on it due to the trade wars itself. However, there was the twist and turn of the Fed stance on monetary policies that cause a lot of fluctuation in the dollar as well. And we must note that the US economic data is still appearing stronger than most economies in the first half of the year. So we can see at the start of the year, the Fed was very dovish. They was saying that there was no more rate hikes, etc. And this actually set the tone. However, after they also state that economy has slowed down drastically, etc. However, if we look after that, they were not as dovish as feared. Why? Because other central banks began cutting their rates, and they were cutting it more drastically as compared to the US. So even though Powell said that he does not see a strong case for rate cut or hike, we can see that next moment he actually started to cut rates as well as lower the forecast. So you can see he opened the door for rate cut in the future, and eventually we look at just last month, US rates were cut as well. So US economic data also appeared stronger than most other economies. If you look at their GDP numbers, you can see that in terms of GDP numbers, they were strengthening, whereas the other nations were actually weakening itself. So unemployment rate was still strong, it's still kept at an all-time low. All right, GDP growth is the second longer cycle. All right, and as well as you can see that PMI numbers is still actually in expansion. However, going forth, we actually see downside risk imminent for the US dollar itself. Even though it may not be as severe as other developing nations, which has impending risks like maybe the euro, the GBP, etc. But against like other safe haven currencies, it could still weaken further. All right, this is due to three main reasons. The first is that the trade war escalation could cause non-confidence towards the dollar, because the impact of the trade wars, we must understand that the US is directly involved in the trade wars, and because of that, people may actually not look at the US dollars in terms of a hedge for the trade war. They may look towards other things like maybe gold, like maybe yen, and because of that, we don't see the trade war as a catalyst towards the dollar itself. All right. There's also much more possible rate reductions going forward. The Fed has hinted so, and of which we can see that the Fed members have actually looked at cutting rates further, aside from the recent rate cut last month. Also, there's worries of slowing domestic and global growth, as well as tame inflation numbers, which will weigh on the US economy. So if you look at the Fed's dot plot, you can see that the Fed is looking at lower rates. All right, they are actually looking at rates sort of like maybe 2% or less. So of which it means that there may still be one more rate cut towards the end of the year itself. If we look at the CME Fed Watch, markets are already pricing in one more rate cut later in September. So all of this will be placed into considerations. If after they cut the rates in September, and if it warrants more rate cut, there may be a rate cut in December as well. So these are all on the cards, and people are worried that further rate cuts will cause reduction or weakening of the dollar itself. So we can see, if you look at the US interest rate futures, it's now implying that the Fed is actually going to cut interest rate by at least 25 basis points towards the year end. All right, so this will be put into sort of like factor into markets, and may cause the US dollar to weaken closer to maybe the FOMC dates, etc. If you look at inflation numbers as well, we can see that inflation numbers have yet to hit the 2% mark, even though it's quite close. So the tame inflation will actually weigh on the Fed's confidence. Weak inflation may also persist, as Fed officials have been recently also stating that they see weaker inflation expectations. We can see that this week itself, two things will weigh on people's concern, or weigh on people's mind. The first being Wednesday, whereby the FOMC meeting minutes will be released. People will look at it for direction to see if the Fed are still keen on cutting rates. Second will be on Saturday itself, whereby we have the Jackson Hole meeting and Fed Chairman Powell will speak, of which the title of his speech will be about interest rates and the measures central banks can do to maintain the economic growth and whether it has reached. And from there, people will be able to see his future direction, and if it's still equally dovish, it may cause the dollar to weaken further. So with that in mind, we are looking at other currencies that may strengthen faster than the dollar, and it may give a sort of like a good momentum play and maybe eventually earn some profits for investors itself. So we will be looking at Asian currencies because this seminar will be covering mainly Asian currencies. So the first one that most people are thinking of will actually be the Japanese yen. Because why? Japanese yen, like the US dollar, is also commonly known as one of the safe haven currencies. All right, it's the world's biggest funding currency, and if like people are not looking at US dollars as a safe haven, they will look at the Japanese yen itself. So right now, with the US Sino trade tensions ongoing, people are looking at the yen, and the yen has actually benefited quite a bit from this because people are looking at the yen as a safe haven as compared to the dollar. So we can see that the yen actually strengthened 1.65% against the dollar over the first half, and this was due to three main reasons. The first thing is that the Bank of Japan was actually more hawkish than expected. What happens is that as the other central banks were actually cutting rates, the Bank of Japan was stating it's going to maintain rates, its current rates. We all know that Japan's interest rate is negative at the moment. So by not slashing its interest rates, it's actually showing its hawkishness as well, because other central banks are actually lowering their rates and putting more aggressive monetary easing, while Japan is actually maintaining status quo. So this actually caused the Japanese yen to strengthen. Second thing is that they actually lowered their inflation outlook. So we all the while we know that Japan's inflation target is actually at 2%. So by them actually lowering their outlook, they're actually putting less focus on it and trying to meet near-term targets first. And with that in mind, it actually put less strain on the Bank of Japan actually to loosen monetary policy so that they can hit their 2% inflation target, and this actually gave strength to the yen. Lastly, was due to its elusive appeal as a safe haven currency. So what happens was that other markets were mainly looking at safe haven appeal, and with the US dollar being directly impacted by the trade wars as well, people are looking at gold and yen as other safe havens, and that's why the yen actually strengthened so much during the first half itself. Going forward, we remain a cautiously optimistic view of the yen. Why? Is because the rhetoric of the yen actually benefiting from the US Sino trade wars is still very strong, and of which it will keep the yen buoyant. However, there are a few possible sort of like downsides that or risks that we may want to put into consideration and monitor closely to the news. Firstly, is that the Bank of Japan may enhance its commitment to ultra low rates to prevent the yen surge, because they wanted a lower yen as well to maintain the inflation numbers. So what happens is that if the yen strengthens too fast, it will actually cause a disruption of their plans, and we have to watch out for what the Bank of Japan is actually planning right ahead. Okay, so we also have to note that despite the positive GDP numbers we saw recently, what happens is that Japan's economy is still quite fragile. We have been seeing that exports has been dipping for 8 consecutive months. Manufacturing is also in contraction, and inflation is still very low in Japan. So all of this will weigh on the Japan economy. And one more thing that people are actually looking very closely to is the 10% tax increase in terms of their sales tax increase in October itself. At present, what happens is that it's still stated to take place, and people are hoping that there may be further delay. But if there's no further delay, it's going to weigh on inflation numbers further, and it may weigh on the Japan economy as well. All right. So one more thing to note is that for Japan itself, it's very much driven by trade also, and people are closely monitoring the trade situation between US and Japan, and as well as the impending tariffs that US have to set on Japan in November itself. If all this goes according to plan and no tariffs were implemented, as well as the fact that the tax increase were delayed, etc., it will actually benefit the yen much more. So we looked at in terms of GDP growth, it has increased in the second quarter. However, if you look at manufacturing, it's still in contraction. We look at exports, they have been decreasing for 8 consecutive months. If we look at CPI, it's still even though it's in expansion, it's still below the 2% target. So if we look at the USD JPY forecast, we see that right now there's still more downside for the Japanese yen. All right, it's still in a downward trajectory. So the next support will actually be the 104 mark, and of which if the immediate resistance will actually be the 23.6% levels. So for China, on the other hand, we see that recently the Chinese yuan was actually placed into huge focus after US actually labeled China as a currency manipulator. But let's look into the Chinese yuan. All right, Chinese yuan is actually differentiated into two different types, the onshore and the offshore renminbi. So if you look at the onshore renminbi, that is not tradable. That is the CNY per se. The one that is tradable is the offshore renminbi, the CNH. So this actually fluctuates closely based on the benchmark rate set, and recently because of the decrease in the decrease in benchmark rates, we can see that the yuan weakened drastically, and this has resulted in the US to call China a currency manipulator, and this have also weighed on the yuan a bit because even though there was no immediate impact by the label itself, what happens that it's not a very positive sign to be labeled as a currency manipulator itself. So we can see that what happens, the US dollar over the past 6 months, because the recent thing of the benchmark increase was done actually in August itself. So if we look at the first half of the year, we can see that the US dollar towards the renminbi has not much, was actually quite stable, but that actually changed in the second half of the year itself. So we actually view more downwards pressure towards the Chinese yuan, right? Mainly because China actually it was widely deemed that China is actually using it to offset the impacts of the Sino-US trade war. So why people are saying that is because the US has been implementing a lot of tariffs on China itself. So when China actually lowers the benchmark rates, it actually caused the yuan to weaken, and this weakening in yuan will offset the impacts it faced from the tariffs itself. Because, for example, if the US companies have to pay additional 20% more in terms of tax to buy Chinese goods, if the Chinese yuan weakened by 20%, it essentially cancels out this tariff impact, and foreign buyers will continue to buy Chinese products. So that is one of the reasons why President Trump was stating that he declared China as a currency manipulator, but it was also used to see that actually China is looking at other means to actually boost its economy as well. So if even though the PBOC has actually stated that they want to maintain a stable yuan, and they pledge to do so as well, if the Chinese economy is impacted by the trade wars further, this may be one of the ways that it may be used to actually lift up the Chinese economy, and if the yuan is set to weaken further because it's actually sort of like impacted closely by the benchmark rate set, we can see more downside in the yuan ahead. Also, we note that China has recently lowered its reserve rates, or sort of like reserve ratio rates, and this will actually increase the debt to GDP ratio of China. So we know that the debt to GDP ratio of China is already very high. All right. So if, like example, by making it cheaper for Chinese companies to borrow more in order to support the economy, it's actually raising the debt levels, and it's a risk of concern. Why? Because the debt bubble in China has been actually growing quite rapidly. So if it grows further, and it does not sort of like shrinks or anything, when it bursts, the impact towards Chinese economy may be much greater as well. So with that in mind, people are actually looking very closely towards the measures placed by the Bank of China as well as the Chinese government, and whether sort of like by trying to use easing measures to actually support their economy, will it actually turn south and in fact harm the yuan and harm the Chinese economy if anything goes wrong. All right, and we can also see that from the Sino-US trade war, China's economy has been facing strong headwinds and strong pressure. We can see it looking from their economic numbers in terms of their manufacturing as well as their production numbers, that external demand has lowered quite drastically. Internal demand is unable to keep up with the loss of external demand, and this has been weighing on the numbers. So with more tariffs put into place, it's actually going to lower the demand for Chinese products even further. China at present have already stated that they are prepared for a long march, a time whereby their economy is maybe not going to do that well, but they are going to sort of like strive on. So all of these are actually signs that maybe Chinese economy may falter going forth, and the yuan may not do that well as well. Aside from the lower Chinese economic numbers, we can see that the recent Hong Kong unrest has also caused a lot of media attention towards China, and this has also affected China's economy as well. Even though it's affecting Hong Kong's economy further, much greater impact, but because of the closely knitted relations between both nations, we can see that China is feeling some strain as well, and this all will impact the strength of the yuan as well as people's perception of the yuan. So if we look right now, there's still much more upside strength for the yuan, for the dollar as compared to the yuan. So the yuan is actually going to weaken further. We can see that the USD CNH pair right now is still in a bullish trend. Even though prices have recently sort of like retraced from its previous high due to the lower benchmark rates, it looks set to test that previous high again. And if it breaks above the previous high, there will be much more upside potential. All right, so the immediate resistance will be the 127% mark based on the Fibonacci retracement. All right, lastly, let's move on to the Singapore side of things, because everybody is definitely interested in the Singapore markets, our home nation. So if you look at the Singapore dollar, some of the fundamentals to note is that it's actually also deemed as a safe haven currency, but if you talk about the global aspect, people will definitely disagree with you. But in terms of the Asia aspect, Singapore's currency is still relatively stable as compared to our ASEAN neighbors itself, and because of that, is deemed as a ASEAN safe haven currency. And people who are looking at ASEAN currencies will actually look to compare against the Sing dollar itself. Against the US dollar, we can see that the US dollar has strengthened against the Sing dollar in the first half of the year, but that was because of a few things. Okay, Singapore's economy was deemed relatively weak. If we look at the recent National Day rally by PM Lee, he did state that the US Sino trade tensions is going to be prolonged and that it has affected Singapore's economy as well. If we look at our trade numbers, our Nordex numbers have been declining for 5 consecutive months. Our second quarter GDP numbers were also affected greatly by the trade war. Why? It's because Singapore is known as an export hub. And because of that, we can see that anything related to trade will impact the Singapore's economy greater. So even though the MAS did not tighten monetary policies, nor loosen monetary policies in April itself, it had very little impact. And towards the Sing dollar. Our Sing dollar compared to other, if we are comparing to sort of like other non-safe haven currencies, like towards the pound or towards the euro, we may be stronger. If you compare to our ASEAN neighbors, towards the ringgit, we are actually quite stable. But however, if you are comparing to other safe haven currency assets, like comparing to the USD as well as the Japanese yen, then we can see that our strength pale in comparison to them as well, because overall our economic numbers have drastically weakened due to our export reliant economy itself. However, we feel that the Sing dollar is going to be resilient in the remaining of the year, because it's still a safe haven currency for most Asian economies, right? And it will be stronger against the emerging market currencies, things like, example, your Philippine peso, your Indonesian rupiah, etc. Also, there has been an effort to gain more global interest, and the MAS has been trying to sort of like release data comprising of net purchase of foreign exchanges on a 6-month basis, further enhancing transparency and trying to keep its economy afloat as well. Even though it's also set to loosen monetary policies during the MAS review in October, but if we compare to our neighbors, or in fact other central banks, it's still not as massive or not as drastic. So you can see that the impact towards weakening the Sing dollar may be minimal as well. All right, so if we see the USD against the SGD, we feel that it's actually going to be a little bit more range bound, and after that we can see that against emerging markets, maybe the Sing dollar will strengthen further. So talking so much about currencies, we definitely have to talk a bit about how you can benefit by trading the various currencies as well. So right now, Phillip do have this MT5, of which 0 comms, and you can trade in smaller lots. Recently, we do offer ASEAN currencies as well. We do offer the Thai baht, etc. So if you are interested in forex trading, you may consider the MT5 platform. We also have the Auto Chartis on MT5, which is a pattern recognition program, and enables you to actually screen through the various currency pairs to find the pair that suits you. So you are able to actually screen through your currency pairs, find the pattern, and see whether you want to proceed with the pattern recognition. So lastly, just to note that right now we have this ongoing promotion, which is our Strength in Asia promotion. So Asian currency pairs, we do have better spreads, and hope it may aid in your trading. With that, I end my presentation, and if there are any questions, I'll answer them accordingly. Thank you.
Thank you once again for attending this seminar. Please contact us at features@phillip.com.sg for any query. We will end the session now. See you next time, and goodbye.